Welcome back to the Daily Crypto Roundup. As we're recording this, Bitcoin is trying to find its feet again after slipping back under that $90,000 level. ETF money is finally blinking and pulling cash off the table. Kraken has quietly taken a huge step toward going public. Washington is getting ready to grill Trump's pick to run the CFTC on crypto regulation. And with the US government now reopened, some analysts are already talking about a full-on wave of new crypto ETFs in 2026. We're going to unpack what this drawdown actually looks like under the hood, why ETF flows have flipped, what Kraken's IPO tells us about the industry's confidence, and how the next phase of regulation and ETF approvals could shape the rest of this cycle. Before we get into it, if you haven't already, make sure you're following the show on Spotify and drop us a quick 5-star rating. It takes 2 seconds. It really helps more people find the podcast, and it tells the algorithm that crypto isn't going anywhere. Let's start with a quick look at the top 10. Bitcoin is trading around $88,500, down roughly 5% in the last 24 hours, as the market tests this high 80s support zone again. Ethereum has slipped back under the 3,000 line and is changing hands around $2,880, off about 8% on the day. XRP is sitting just above the $2 mark, roughly $2.03, down close to 9%, giving back some of that huge move we've seen over the last couple of weeks. BNB is hovering in the high 800s, about $879, down around 6%, still one of the more resilient large caps even in this pullback. Solana is trading in the low 130s, roughly $131, down around 7 to 8% in the last day, while Cardano is back in the mid-40s of a cent, about 44 cents, down just under 8%. Dogecoin is around 14 to 15 cents, off roughly 8%. Tron is holding up a bit better at about 29 cents, down around 3%. And then rounding things out, Litecoin is in the low 90s, roughly $92 to $93, down around 4 to 5%, while Bitcoin Cash is trading in the mid-400s, around $475, down just under 10% on the day. So the board is mostly red, but as we'll get into, there are some signs that buyers are at least starting to push back at these levels. Let's start with that broader market picture and the Bitcoin drawdown, because it sets the tone for everything else. Bitcoin slipped back below $90,000 again during early US trading, logging another 4+% daily drop and extending what's now almost a 30% drawdown from the all-time highs we saw earlier this year. One research note from K33 pointed out that this drawdown now ranks among the worst corrections we've seen since the 2017 cycle in percentage terms, and in speed, with nearly 30% shaved off in just over 40 days. They frame this not as some freak event, but as very much in line with how Bitcoin has behaved in every prior bull market. Big parabolic legs up, followed by violent resets where leverage gets flushed and late entrants get shaken out. On-chain, firms like CryptoQuant have been talking about this as the most bearish phase since 2023 in terms of sentiment and technical structure. Funding has flipped negative. Short-term holders are deep in the red, and you've got long-term cohorts starting to trim into strength rather than aggressively accumulate. But their argument is that this is exactly the kind of environment where the market can build a new base. Derivatives leverage has been cleared out. The froth in meme coins has cooled dramatically, and spot buyers with longer time horizons are starting to step back in at these lower levels, rather than chase at the highs. You can see that dynamic even today. While the numbers I've just read out are red, Bitcoin is still holding above that mid to high 80,000 support area that traders have been watching. And altcoins are no longer underperforming to the same brutal degree we saw during the first leg of this correction. In other words, it's still painful, but it's looking less like a panic and more like a market that's trying to decide whether this zone becomes a bottom or just a pause before another leg down. One of the big reasons this move has felt so heavy is what's happening in the ETF world, and that takes us to our second story. BlackRock's flagship spot Bitcoin ETF, IBIT, has just recorded its largest ever single-day outflow. Investors pulled around $523 million out of the fund in one session, marking the 5th straight day of net redemptions and the biggest withdrawal since it launched back in early 2024. When you zoom out, ETF products across the board have now seen roughly $3 billion in net outflows as this correction has unfolded, reversing a chunk of the monster inflows we saw when Bitcoin was grinding towards those record highs. For months we've talked on this show about ETF demand being the structural bid under the market, the thing that soaked up new supply and helped push Bitcoin through one psychological level after another. Today's data is the flip side of that. When the same institutional and advisory money that bought through an ETF decides to de-risk, they do it through the same simple wrapper. And the selling pressure can be just as mechanical on the way down as the buying pressure was on the way up. Derivatives data backs that up. You've got funding rates slipping negative, basis compressing, and options skew flipping heavily towards downside protection, all of which suggests that fast money is finally leaning into the move rather than trying to catch the falling knife. That's painful in the short term, but if you think about what analysts like Vetle Lunde at K33 have been saying in recent months, there's an argument that big leverage clearouts and forced ETF rebalancing can actually set up better long-term entry points once the dust settles. And at the same time, it's not as if the ETF story itself is over. Matt Hugin, the chief investment officer at Bitwise, was on CNBC talking about what happens next now that the US government has finally reopened and regulatory agencies can get back to running at full speed. He said there is huge demand for crypto ETFs and exchange-traded products, and he actually described the next phase as ETF Palooza in crypto land, predicting we could see 100+ new products over the next couple of years. His point was that while today's flows are negative, structurally the pipeline is still building, not shrinking. We're going to come back to that ETF pipeline later in the show, but for now, let's park the flows and talk about a very different kind of signal. A major exchange getting ready to step onto public markets. Kraken has just confirmed that it has confidentially filed for an initial public offering in the United States. They've submitted a draft S-1 to the SEC, which is the document you need to kick off the IPO process. We don't have any details yet on valuation, share count, or timing, because a confidential filing allows the company and its bankers to go back and forth with regulators before putting everything in front of investors. But the key point is simple. One of the oldest and most established exchanges in the industry is actively planning to list on a US stock exchange as soon as the window is open and conditions are right. That matters for a few reasons. First, it shows that big crypto businesses still believe they can meet US disclosure and compliance standards and be rewarded for it with a premium valuation. Kraken has been around since the early days. It's weathered multiple bear markets, and it's spent a lot of money over the last few years on licensing and regulatory relationships. A successful IPO would effectively turn all of that into a stamp of approval from public markets and could encourage more firms, think stablecoin issuers, infrastructure providers, custody specialists to follow. Second, it sits neatly within a bigger trend that people like Julian Klimochko, a Canadian fund manager who watches the IPO market, have described this year as the crypto IPO window being wide open again. We've already seen Circle go public, we've seen filings from Gemini and Bullish, and now Kraken joins that queue. So even on a day when tokens themselves are under pressure, the equity side of the ecosystem is quietly preparing for the next expansion phase. And third, it sends a message to regulators. This industry isn't going to stay in the shadows. If you want big, systemically important firms to behave like banks and brokerages, you have to give them a path into the same public markets everyone else uses. Kraken pushing ahead with an IPO is a way of calling that bluff. We're going to take a very quick break for our sponsors. When we come back, we'll talk about Trump's nominee to run the CFTC and why today's Senate hearing matters for crypto regulation. And then we'll zoom out and look at why some analysts think the end of the US government shutdown could actually unleash a whole new wave of crypto ETF approvals. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
All right, welcome back. Let's talk Washington, because there's a lot going on behind the scenes that will shape how crypto is regulated over the next few years. Today, U.S. senators are grilling Michael Selig, Trump's nominee to chair the Commodity Futures Trading Commission. Selig is not some random outsider. He's currently the chief counsel for the SEC's Crypto Task Force and an advisor to the Republican SEC chair. So he's one of the people who actually knows where the bodies are buried in terms of enforcement actions, legal theories, and the internal debates over whether particular assets should be treated as securities, commodities, or something in between. At this hearing, senators are expected to press him on two big buckets of issues. First, how he plans to overhaul crypto regulation if he's confirmed, and second, how he'll handle high-profile questions like election betting markets and leverage products that sit on the edge of retail speculation and systemic risk. For the industry, the main question is whether Selig will push for a clear division of labor between the SEC and CFTC, with the CFTC taking primary oversight over spot trading in Bitcoin, Ethereum, and possibly a wider basket of non-security tokens. If that happens, you could see a situation where exchanges listing those assets are regulated much more like futures platforms or commodities marketplaces, with stricter rules on margin, custody, and reporting, but also a clearer rulebook than the current regulation by enforcement mess. On the flip side, if he signals that he wants to keep things vague, or that he sees his role as backing the SEC's more aggressive posture, then markets may start pricing in a longer period of uncertainty. Either way, what's being discussed in that hearing room isn't just abstract law. It's going to feed directly into how easy it is for a platform like Kraken to operate once it's public, how quickly new derivative products get approved, and how confident big advisors and institutions feel when they allocate through ETFs or structured products. And that brings us to our final story for today, the reopening of the US government, and what that could mean for the next wave of crypto ETFs. After a long and painful shutdown, the US government has finally reopened, and agencies like the SEC are getting back to something close to a normal schedule. On the surface, that sounds like boring process news, but for crypto, it could be a huge deal. Why? Because the pipeline of new products that was effectively frozen during the shutdown can now start moving again. Analysts talking to outlets like Cointelegraph and TradingView are already framing 2026 as a potential ETF year 2, not just for Bitcoin, but for a much wider range of single-asset and index-based products. Matt Hoogan from Bitwise put it pretty bluntly. He said there's huge demand for crypto ETFs and ETPs, and that as the regulatory logjam clears, we could see what he called ETF Palooza in crypto land, with more than 100 new launches over the next couple of years. In his view, the most interesting piece of that is not necessarily more Bitcoin trackers, but index-style products that bundle multiple assets together for investors who just want a small, passive slice of the market. If that plays out, you end up with a very different structure to the one we've had in this first leg of the cycle. Instead of flows being hyper-concentrated in a handful of spot Bitcoin vehicles, you'd have money trickling into Ether ETFs, Solana ETFs, maybe even baskets that wrap DeFi, gaming, or infrastructure plays into a single ticker. That could smooth out some of the violent single-asset moves we've been seeing, but it also means that narratives will matter even more. Because every time a sector gets a new ETF, it gets marketing, distribution, and a seat at the asset allocation table. Now, it's important to say that none of this guarantees higher prices. In fact, today's record outflows from BlackRock's IBIT are a reminder that these vehicles can add downside pressure as well as liquidity. If advisors decide they want to cut risk, they can do that with a couple of clicks, and billions of dollars can leave the space just as quickly as it arrived. The lesson from today's tape is that structural demand doesn't erase the cycle, it just amplifies it. So where does that leave us as we wrap up? On one side of the ledger, you've got a nasty but historically normal Bitcoin drawdown, heavy ETF outflows, and a lot of red on the board. On the other side, You've got a major exchange like Kraken stepping up to become a public market company. A regulatory conversation in Washington that at least acknowledges crypto is here to stay. And a reopened government that's clearing the way for what could be a second wave of ETFs and ETPs in the next couple of years. In other words, it's messy, it's uncomfortable, and if you bought the top, you're probably feeling sick. But structurally, the building blocks of the next phase, public listings, regulatory clarity, and more sophisticated investment products, are still being put in place even while prices are correcting. As always, none of this is financial advice. Do your own research, manage your risk, and don't let anyone on the internet tell you how much you should or shouldn't allocate to a volatile asset class. That's it for today's Daily Crypto Roundup. If you found this useful, make sure you're following the show on Spotify, drop us a 5-star rating, and share the episode with a friend who's trying to make sense of this correction. Thanks for listening, and we will see you at the top.